It's the 1st of August, so time for our stock market analysis. Let's take a look at what has happened to the markets in the last 30 days. So July closed as a really bullish month, so breath of fresh air. And since we made the low in the markets on the 16th of June, let's take a look. The markets are up. S&P 500 is up from the low all the way to where we closed on Friday last week. We're up 13.49%. Really, really bullish. So since then, the market has reversed into a short-term uptrend. Why? Because the 20 EMA, this red dotted line or this red thin line, has right about crossed the 40 EMA and crossed above that 50 moving average. So this is an indication of a short-term change in trend from a downtrend to an uptrend. And you can see that from the price action as well, right? You can see this price action making lower lows, or rather lower highs, lower highs, lower highs, lower highs, lower lows, lower lows. And it was within this trendline resistance. So what happened was we broke above this trendline resistance, and we're now making higher highs and higher lows. So very clear change in the short-term trend. And what's pretty amazing about the market, and that makes it pretty bullish, is that we had actually pretty negative economic news. So if you guys recall, we had on this day the news that the Fed announced their 75 basis points rate hike, which means they increase interest rates by another 0.75%, bringing the Fed funds rate from 2.25 to 2.5% target range. And how did the markets react? Boom, it went up. So why is it that the Fed raises interest rates and the market goes, yes, let's go up, right? Well, because like I said many times before, that the market has already priced this in. The market already expected the Fed to raise interest rates by 75 basis points. Now, of course, if the Fed raised more than that, then we could have gone down. But the Fed did exactly what the market expected. So the news was already priced in, so there were no surprises, and the market went up. But the market went up for another reason. It was what the Fed chairman said. So if you listen to his speech, now previously he was very hawkish. Now hawkish means that very aggressive in saying that we're going to tighten monetary policy, we're going to raise rates until we kill inflation. If we have to bring the economy down, then too bad, right? So that's what he said the last few meetings. But this time he was not as hawkish. He was more dovish. So dovish means that he's now kind of like, well, maybe we may not have to raise rates anymore, or we may slow down the rates, right? So the market took that is that the Fed is beginning to pivot from aggressively raising rates to now slowing down the raising of rates, or even pausing, or even cutting rates next year. And that was the sentiment that changed the market, and that's why the market went up. So what was it about the statement which he said? The first thing he said was that after raising interest rates now, we are at a neutral rate. So what neutral rate basically means is that I think it's enough to combat inflation. Okay. Now, as you guys know, the last inflation reading was not very good. It came in like 9% worse than expected. But the Fed, like what I'm seeing, is he's seeing a lot of the leading indicators. So leading indicators are things like, again, oil prices coming down. In fact, the US dollar has been coming down. The 10-year yield has been coming down. So housing prices have been coming down. And companies have been announcing that they're going to slow down hiring. So they can see all these slowdowns happening. They can see the easing of supply chains. They can see that a lot of these commodities that have been pushing up inflation are beginning to come down. So they are seeing the leading indicators to make them think that inflation has peaked. And that's why the Fed chairman said that we'll see from here. Because initially he said we're going to raise rates all the way to the end of the year. Now he's saying that, well, let's see what happens. Whether we keep raising or we pause depends on the economic data. And that was music to the ears of the market. And that's why the market went up, right? And then the next day we had GDP coming in negative. So 2 quarters of negative GDP growth. People think it's a recession. Well, not really. Well, it's a kind of like a technical recession, 2 quarters of negative GDP growth. But what the Fed chairman said was that, well, it's not really recession because the labor market is still strong, unemployment is still very low, and you can't define a recession with a strong labor market, right? But anyway, despite that negative GDP, boom, market went up again. So what does it mean? So I keep saying that, you know what? Bear markets don't die on good news. Bear markets tend to die on bad news. In other words, when you find that you've got bad news, but the market doesn't go down anymore, usually it's a very bullish sign. Usually it's a sign that the market may have bottomed. I mean, no, there's no guarantees, but it's a pretty bullish sign. All right. And of course, it went up. The other thing you can also rationalize is that, in a way, bad news is good news, right? Because now that the Fed can see that GDP has beginning to decline, the economy is softening, that tells them that they can't be aggressive anymore. They have got to start moderating their interest rates increases. Now, having said that, the market is still pricing in a 1% rise for the rest of the year. The market is still pricing that in. In other words, by the end of the year, we should have interest rates of 3.25% range to 3.5% range. That's what the market's pricing in. Okay, so if the Fed does that or does less, then hallelujah, the market will continue running up, right? But we'll see how it goes. So by the way, before you get too excited and too bullish, do note that we are still in a bear market. This is only a change in the short-term trend, but it's still in a bear market. So what must happen for the bear market to confirm a reversal into a bull market? So there are 2 things that need to happen for a bull market to be confirmed, either this or that, right? The first thing that needs to happen is if the market can go up 20% from its lows, that confirms a bull market. So where's that level, right? So you can see that's the low over here, back 16 June. So 20% from that low will be here at this line I've drawn over there, which is about 4,380 points. So if the market can close above this level and stay there for at least 30 days, that's a bull market. So we're not there yet. We're not in a bull market yet. So that's the first thing that has to happen. Or we need to see that the 50 moving average, this blue line over there, has to cross above that 150 moving average, which is this green line, and both moving averages have to start sloping up to confirm a bull market. Now, by the time that happens, you can imagine that prices will be a lot higher than where they are today. Prices would be probably again over there, right? And that's why, in a way, when people say, Adam, why don't you wait for a confirmed bull market to start buying stocks? You can do that, right? I'm not saying that's wrong, but oftentimes by the time the bull market is confirmed, prices will be a lot higher than where they are today. And by the time you get back into the stock market, you will probably be overpriced, right? Or not really undervalued anymore, okay? But then again, for people who are short-term traders, they don't care about valuations because they just get in, get out fast with a stop loss, fine. For trading, you want to wait for a confirmed bull market to start taking long trades. But again, for investing, we've got a longer-term perspective, so we don't really care too much about the short-term trends. We just want to get in as cheap as possible because the lower you buy from intrinsic value, the bigger your margin of safety. So we don't mind buying even before the bull market is confirmed, even if it's still a bear market. And that's why, as you guys know, I have been slowly averaging in my positions because ultimately I want, in the long run, to hold great companies at lower prices. All right. So again, no bull market has ever started without first a change in the short-term trend. But not every short-term trend leads to a bull market. You get what I mean? So in other words, this change in the short-term trend is good because it could lead to a bull market, but it's not 100% certainty that this will lead to a bull market. Now, I'm watching a few levels here. So bear in mind that in the last few days, the price has gone a bit extended over here. So remember that nothing goes up in a straight line, right? You don't get like, oh, all the way up, right? You get wave up, wave down, wave up, wave down. You always get wave ups and waves downs. So it always makes sense to me to buy on wave downs and not chase the wave ups. So in other words, I believe a lot of us have done a lot of buying already, right? If you've been watching me, how I've been adding in. And now you can see that after we broke above this 50 moving average, we retraced, we had a wave down, and now we found support at this 50 moving average, which is a good sign, right? You break above the moving average, you find support, and then boom, it launches back up over that. So right now we are on this wave up. Now, will it wave up forever? Of course not. It's going to wave down again, right? So you can see that we are approaching now a level of resistance. You can see that this is a previous support level over there. I've drawn this line. So this support would potentially become resistance right there, about 4,180 points. So we're very close to this level. Today and tomorrow we'll probably reach that level. So don't be surprised that the market is going to go up and hit this level, and guess what's going to happen when it hits this level, right? There's going to be some selling pressure. So don't be surprised that when you see that the market's going to start to wave down again, all right? That's going to be very, very normal when you hit a level of resistance. Now the question is, after it waves down, will it break through and then hallelujah, right? Or is it gonna wave down and then come all the way back down again? I mean, that's something that no one can predict, right? So if you listen to the people in the media, half the people believe that this is the bottom. It's the bottom. We're not gonna go lower and we're gonna go up from here, although very, very choppy. So half the people believe that, okay? But another half of the people believe that, no, this is a bear market rally. This is not the low. It's not the bottom. Don't get fooled by this rally. It's going to go up and you're going to get excited and it's going to break your heart and go all the way back down again. All right. So again, no one can tell the future. All right. Both scenarios can play out. But you guys know me. I tend to be a bit more optimistic. So I'm kind of leaning on the camp that these are the lows that we've made and that we will go higher. But it will not be a straight line. We'll go through, a lot of choppiness, up and down, but slowly we'll grind higher. By the way, I do hope that you enjoyed catching our live webinars at the Great Market Purge event. And if you miss any of those webinars on real estate or options trading or stock trading or price manipulation or my investing seminar, you can always catch the replays if you're registered. If you're not registered, you can still go to our website, piranhaprofits.com, and chat with our staff down below on the chat box to get registered to the free replays. And by the way, remember that for a very, very short period of time, we've got all our courses and playbooks up to 70% off their retail prices. So take advantage of it right now while it still lasts. But of course, there is also still a possibility that we could go back and make a lower low. So what would determine that? Right? I think it's all determined by two things. Number one, it's determined by inflation. So right now, like I said, a lot of people are seeing, the Fed is seeing that, I'm seeing that it looks like inflation has peaked and it's coming down because of all the leading data, right? Now, if inflation continues to trend down, then I believe that this is the bottom, okay? But if suddenly the war gets worse, or China's lockdown gets worse, or something happens, and inflation spikes up again, then guess what? Then the Fed will have to say, I'm sorry, we're going to get aggressive again, we're going to go hawkish again, we're going to raise rates again to bring down inflation, then definitely the market is going to definitely come back down again. All right, so that's something I can't tell you because I can't predict whether inflation will go back up. But as of now, if inflation stays, then that should be the bottom. All right, so that's the first thing that could screw this up. Okay, the second thing is whether or not we go into a deep recession, an actual recession. Again, right now it's a technical recession, no big deal. The market in a way has already priced in a mild recession because the market went down 25%. All right, so for the market to really go down a lot more, which some people are saying go down 35%, which is most bear markets go down 35%. Most recessionary bear markets go down 35%. People are saying it's going to happen. Could it happen? Yes, it could happen if we really go into a deep recession. All right. And will that happen? That's something that no one can predict. Okay. But that is the second thing that could bring us down to a new low of 35%. But whatever the case, even if that happens, guess what? Eventually it's going to bottom and it's going to go up anyway. So like I said, as an investor, whatever happens, whether we have bottomed now or we're going to bottom in a few months at 35% drawdown, it doesn't really matter in the grand scheme of things. Because if you take a 3 to 5 year view or even a 10-year view, you're going to be a lot higher than where you are today. Especially if you buy great companies, you're going to beat the market, you're going to get double-digit returns, right? So all these things that I talk about are really for entertainment purposes, because I'll continue to keep buying great companies when they retrace to support levels. So over here you can see, the Fed funds rate after the last raise is here, right? It's between 2.25 to 2.5% target range, okay? And by the end of the year, the market is pricing in another raise to here. So will this happen? It all depends on the data, the inflation data, the economic data. But if it happens, the market has priced it in. Anything lower than that, market will really get excited. But of course, if it gets worse than that, then market could, of course, come down again. Now, some people are, of course, a bit concerned about the yield curve. So historically, whenever the yield curve turns negative, which means the 10-year yield goes below the 2-year yield, right? Which you can see, this is the 10-year treasury yield minus the 2-year treasury yield. It should be positive. When it's positive, the yield curve is upward sloping, right? But when the 10-year minus the 2-year turns negative, that means the yield curve inverts. That's usually a leading indicator of recession. But again, it can't tell us whether it's a deep recession or shallow recession. It's just a recession, right? And again, historically, you can see that every time the yield curve turned negative and went up again, boom, you got recession. This gray area is recession, right? Yield curve went down, went up, recession. Yield curve went down, went up, recession. So it's happened, now not every single time, but it happened most of the time, right? And again, over here, right? Here, it just touched a bit, went up, recession. And now people are freaking out. Oh my God, it's happening again. The yield curve is turned negative. And if it goes up, we're going to get a recession. Could that happen? Maybe, right? So people are concerned about that. Now, but on the other hand, you have got this indicator telling you that a recession looks inevitable, right? But on the other hand, you've got other indicators that tell you that, hey, even if we do get a recession, it's not going to be really bad. Why? Because if you look at this other indicator, it tells you a more bullish story, right? So in this over here, we have got a chart comparing the S&P earnings yield with the 10-year treasury yield. So basically it tells you that the S&P yield right now is 4.79%. Okay, this blue line is the S&P 500 earnings yield. And this green line is the 10-year treasury yield, which are the 10-year bond yields. So what does this mean? This basically means that if you were to buy bonds now, you buy a 10-year bond, the return you get a year is 2.66% return. But if you buy stocks now, S&P 500, the yield that you get, the earnings yield, is 4.79%. So which gives you a better return? Stocks or bonds? Stocks. Stocks give you a better return than bonds. So based on this, people tend to what? Buy more stocks, buy less bonds. So that's bullish on the stock market, right? Now, if you look historically, during the last two bad recessions, the dot-com crash, right? So this was the dot-com crash, 2001, 2002. What happened prior to the crash? Prior to the crash, you can see that the 10-year bond yield, right, the green, was above the S&P 500 earnings yield, which means at the time, stocks were overpriced relative to bonds, right? And that's what caused a massive crash in the stock market. Same thing that led to the 2008 Great Financial Crisis. Right before that recession hit, what happened? You can see over here, again, the blue line, the S&P yield, cross into the green line, which means now that stocks are no longer that attractive relative to bonds. So is that happening right now? No. Right now you can see the blue line is way above the green line. Okay, so if the blue line gets close to the green line or below the green line, then yeah, you may want to freak out, right? Because that means to say now that stocks are too expensive relative to bonds, but now stocks are cheaper relative to bonds. So, when you analyze the market, there's so many moving parts, right? On one hand, the yield curve says, oh my God, we're going to go into a recession. But on the other hand, you look at this and say, well, stocks are still cheap relative to bonds, okay? And that's why no one can know for certain. To determine whether we're going to go through this bigger market crash or bigger recession is really the profits of the S&P 500 companies. Remember, ultimately, it is the profits of the company that will determine the share price, ultimately, right? And I keep saying that if you look at, again, the last major recessions where the market crashed 30-50%. This was, again, 2020, 2008, Great Financial Crisis, and dot-com crash. In all those cases, what happened to the earnings of the companies? The S&P 500 earnings declined massively. These are the earnings per share of the S&P 500 companies, right? Dropped, 25% over here. It dropped 40% over here. It dropped 35% over here. Okay, so again, for us to get that kind of crash that people are looking for, the bears, we need company earnings to drop 30-40%. And is that happening? Well, I don't see that happening. You can see in quarter one, definitely it's slowing down, right? But it's still growing, right? So in quarter one, it grew at 10%. Now, we are right now in the middle of quarter two earnings. And people expected it to be horrible. They expected companies' earnings to collapse. But so far, earnings have been better than expected. And that's another reason why the market has been rallying, because earnings are like, okay, not too bad. Of course, there were some disappointments, like Snap was disappointing, Meta was disappointing, JP Morgan was disappointing. But then there were some positive surprises, right, that were better than expected. Like Apple was better than expected, for example, right? So generally, if you look at quarter two earnings, so far for quarter two, you can see that the percentage of positive and negative earnings surprise. So far, close to 80% of companies have reported above expectations. Surprise, right? And 20% have reported below expectations. So in other words, earnings are still good, right? And these are the actual numbers you can see broken down for large caps. Most of us are invested in large companies, as you can see. The market expected earnings to decline by 6.8% for this quarter. But so far, it has not been as bad. Earnings declined 2.6%. Not as bad as expected. Remember, we need earnings to decline 25, 30, 40% to get that kind of big recession, right? So even at a 2.6% slowdown, it's really no big deal, right? And those are large caps. If you look at mid caps expected growth was 6.9%, but better than expected. Mid caps grew at 14%. Holy shit, right? Small caps, small companies expected to decline by 11%, but so far now it's declined by only 1.7%, right? Now, if you look at the breakdown of sectors, you can see that the biggest disappointment, well, not really disappointment, but they expected financials to be the one that declined, right? And it did decline, but less than expected, right? They also expected communication services, which is basically advertising, around Meta and Facebook and Alphabet and Snap. They expected a 16% decline, but not as bad as expected. Real estate, they expected 27% decline, only declined 4%. So not as bad as expected. And all the other sectors, they expected growth, right? Like energy, they expected 42%, came out 47%. Industrials expected 50%, came out 55%. Consumer staples expected 3% decline, came out 4.9% growth. So earnings so far better than expected. And unless this changes, the market is unlikely to go back down again. Okay, so if you take a look at the last 1 month that's been bullish, which have been the sectors that have been leading the market? And surprise, surprise, it's been consumer cyclicals, also known as consumer discretionary. This has been leading the market. Second, technology. Third, industrials. Now, is this a good sign? I think it's a pretty good sign. You know why? Because if the market goes up, but the sectors leading the market are defensive sectors like consumer staples, like utilities, like healthcare, then that's not a very good sign, because it tells you that the market is expecting a recession. That's why the defensive sectors are outperforming. But in this case, it is not the defensive sectors that are outperforming. It is the cyclical sectors, right? Consumer cyclical, technology, industrials are outperforming, which is a sign that the market is thinking that, hey, we don't think there's going to be a very, very bad recession. In fact, consumer defensive in the last 1 month and the last 1 week have been nearer the bottom. So people are getting out of defensive companies, out of healthcare companies, and into the more economically sensitive and growth companies, right? So that's another bullish sign. So you can see there are bullish signs, there are bearish signs, and you weigh which one do you think is stronger. For me right now, I still look at the bullish signs as a bit heavier than the bearish signs, okay? If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Khoo, and may the markets be with you.